Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we've made it. We're now at the end of the year. This will be our last Frac spread show for the year and our last show of the year. So because of that, we hope you have a great, happy holidays, happy New Year, and we look forward to working with you and seeing you in January. So, but we have to go out with a bang. So we'll have a little bit to cover just because we had some data dumps coming out of the U.S. that we'll just go through. But in this one, we're just going to do the frac spread count, the rig count, look at some things that have happened seasonally speaking, and then going more into where we sit on inflation and some of these other key drivers into year end, because it's going to be an interesting 2022 for sure, especially as we go into Jan. So with that being said, one of the things that we have now is our favorite, the Primary Vision frac spread count, which came in at 244. So we went from 256 to 244, a drop of 12. And one of the things is there was essentially a steady drop across the board. There's not one area that really led the drop. But one of the key pieces that we continue to see is a lot of demand and a lot of activity in the Haynesville, in a lot of these natural gas areas. And as we said in yesterday's EIA show, we really honed in on where LNG capacity is. We have 10 cargoes that are going into Europe right now, already in the water. So there's a lot of things that are moving around. We had some ships do some U-turns to head back to Europe. So natural gas and LNG in general is going to remain a bright spot. And then we also have the NGL side. We have the liquid side, which is going to be a bright spot as we go through into next year. And in our insights that came out today, I did a little bit of a deeper dive on where ethane pricing is, where propane pricing is, and why that's going to be supportive of activity going into the new year. One of the key pieces that we also wanted to highlight before we go to the seasonal look, the Permian's had a little bit of a step down, but very small. Like, we're still seeing the Permian remain very robust, a lot of activity continuing to happen within that area. And we don't see too much of an additional slowdown. So we obviously have the seasonal drop. The question is going to be, is this the last one? And then we have a little bit of a bounce next week. Because this is going to go right into New Year's, typically, you get the drop now, and then you have a little bit of a slowdown. But then once Jan 1 kicks around and you start getting into that new year, then we'll start to see this activity pick right back up. And we should be to about 275 spreads really by the second, third week of January, especially given where pricing is right now on all three streams. This isn't just a comment on oil, but we really have to appreciate where are NGLs, where's condensate, and realistically, where's natural gas, because all of them are showing and really being supportive. And one of the things that we continue to look at, because we do think that there's going to be a little bit of a settling on crude pricing, but you're going to see liquids still remain robust. And given there's always a connection, there's always a certain spread between the two. But we do think that the liquid side is starting to stand a bit more on its own, and we'll continue to see some price appreciation on that level. So when we think about these 12 spreads coming down, this is looking at the national spread count over the last 7 years. And I think it's just very important to look at what is happening this year, where we're seeing the normal slowdown, but the pace of that slowdown is not really where it was in 2019, in 2018, in 2014, in 2016. We always have this big drop, but we're just not really getting the same type of drop because we're starting from a lower level, obviously just in terms of where we are. But also pricing is there, and there's just more demand, and there's more activity that's going to stay the course versus what we had in 2019, where you saw that big drop down, versus what we've had in some of these other years, especially 2018. You had that big drop. But when it's important to look at where things kick back up in January, and you can see that there's usually that quick snapback, and then January, obviously weather permitting, has a lot of that recovery. But the fact that the Permian's not really coming down, we should see the Permian come down a bit more this week. And then that'll be the low, and then we'll have that nice springboard to kick off the new year. Then when we look at rigs continue to be the bright spot. We had 7 rigs get added in the U.S., 5 in oil, 2 in gas. And then when you look at the breakdown, we had 7 horizontal, 1 vertical added, and then 1 directional coming off. So again, that horizontal side, 7 horizontals. When you think about that, is what is creating the duct. So verticals are gonna, you're gonna create your vertical drill. Then those horizontals will come in, and then they're the ones that are going to really put you into the position where that can now get put into the duct count. And a lot of this activity is happening in both Texas and New Mexico, aka the Permian. So we still continue to see the Permian really trying to address the fact that we've seen a lot of these ducts get worked through and building up that new capacity to make sure that we can hit the ground running in Q1 and beyond, where we'll see spreads come back, sit at about 275 as we go into the beginning of Feb. But then you're going to have this little bit of a lull in terms of when these new spreads or additional spreads will come in, and then but that'll give the rigs more time to operate, the rigs more time to increase some of the running room that's going to be needed to make that bigger push in Q2 and Q3 of next year. Now, just because we're not going to have our EIA show next week, we just wanted to provide a quick update. You can see in Europe, there was a small build pretty much across all products, right in line with what we were thinking in terms of gasoline, in terms of gas oil, and kind of where things sit going forward. We do expect to see a little bit of an increase in gasoline into the U.S., just given where the timing is and where they sit in terms of storage. Then when you look at Singapore had a small drop. It was really driven, again, by middle distillates, but we do see that reversing. There is a lot of that capacity that is being moved into the system. And then light distillates right in line with kind of what we were thinking of, just more of a sideways move. One of the things that we just wanted to highlight, Libya. So the election organizers have canceled the presidential election, and now they're looking to hold it on January 24th, which is the date of the parliament election. So we're hoping to see that. Right now, it's unclear to see how this is going to replace it. The oil protests have continued for the most part. But according to the oil production, there's 2 different numbers that are being thrown out. The oil minister is saying that there's no change. They're at 1.2 million barrels a day. But then the NOC is saying that they're at 900,000 barrels a day. So who's right, who's wrong, is going to dictate what our exports look like. There's enough in storage as long as the ports remain open. There's enough in storage to hit their current numbers and really to carry them through the midway of Jan. It's when we get to the back end of January that we could start to see some issues. If Libya comes down and we don't see them exporting, that'll be supportive of a little bit more purchasing of Urals. But more importantly, this will be supportive of Nigeria. So we'll see Europe looking to diversify a bit, pick up a bit more Urals and a bit more Nigerian cargoes. If we were still at the previous export levels of U.S. capacity, we would say U.S. exports would increase. But they're already pretty much at a peak of what they can tolerate. So this is really going to be more of a positive for West Africa than it is for the U.S. And then another backdrop for the Urals as the European crisis, or the Ukraine-Russian backdrop continues to play out. Now, we finally had the final core PCE. So some of the pieces in the market-based core PC. So there were some holdouts on going bright red in terms of the measure, and the red here is a measure that is more than 50 basis points above target. So now if you remember, there was one piece that was still yellow, and now we are now fully on in terms of where we are above that target rate. Everything is now bright red. Again, screaming that the Fed needs to act. There will be, as we've talked about, the competing pressures in terms of leading into that stagflation. But again, it's just the pace of inflation will slow, but there still will be inflation, and there will still be pressure, especially when we look at the consumer and what is happening at the consumption level, which is where we got our fun data dump. So initial jobless claims, continuing claims, kind of very close to estimates. We talk about this in our econ show segments 2 and 3 in terms of just we're now actually below what is deemed as natural unemployment. So again, more impetus for the Fed to ease, to start to tighten. Personal income came right in line with expectations of 0.4. Same with personal spending of 0.6. But then when you take in real personal spending, this is factoring in inflation, expectations were supposed to be for 0.2% growth. It came in at 0. This is exactly what we had predicted was going to happen for November. And this is where we were starting to see that bite from inflation. We're starting to see people really adjust the way they're purchasing. And we're going to have some more charts on that in a minute. PC deflators coming in right in line with expectations, but core deflator was higher than expectations. Now, it was expected at 0.4, came in at 0.5. Core deflator year over year was expected at 4.5%, came in at 4.7%. Again, accelerating into November. We'll see some slowdown on the rate of change in December, and then we could actually see a negative print or a deflating print in January and February. But then we see that accelerating again March into the beginning of summer. Durable good orders came in strong, was expected at 1.8%, came in at 2.5%. But capital good orders, non-defense ex air, was expected at 0.7 and came in at negative 0.1%. So a little bit of a mixed bag, still a net positive. It's just a matter of what bucket we're going to look at, and we'll talk about that more in the new year. The Langer Consumer Comfort came in below last month at 47.9, so a little bit of that slowdown, where Michigan sentiment came in right in line with expectations. Not too much to say there one way or the other, with the view that inflation will still remain well over 4.5%. And then new home sales came in right in line with expectations with expected 770,000. It came in at 744. But the new home sales month over month on a percentage basis was expected 3.4%, came in at 12.4%. So closing out the year, fairly strong. But when we start looking at and aggregating a lot of these different business leading indicators, the long-term macro index continues to show to late cycle. 96% of the different indices have now peaked. This is, again, showing just kind of where we sit on the business cycle stage, which is more concerning, in our opinion, for where demand is going to be when we start looking globally in terms of manufacturing, in terms of consumption, because we do see some of these headwinds that are going to persist. And not to say that we're going to drop right away, but you can see that you can only hang out there for so long before the pressure moves you down. And because we have this monetary tightening on a global basis, and we talked about it again in our econ show, that this is going to be some additional drag on where some of this growth is going to come from. Personal consumption, this is just looking at it in terms of how we continue to be up and out. November PC inflation came in at 5.7% versus 5.1% in the prior month, and again, revised up. Core coming in at that 4.7%. And just to put this into context, the rising at the fastest rate since 1982, and the core is rising at the fastest rate since 1989, just to give you an idea of how we're accelerating. And these are the concerns that the Fed has, which is why we do see rates increasing. We do see an acceleration in tapering. Taking this to the next level, looking at spending, the U.S. consumer spending adjusted for inflation stagnated in November, right in line with our expectations, as the fastest price gains in nearly 4 decades eroded purchasing power. Purchases of goods and services after adjusting for higher prices were little changed, following a 0.7% gain in October. Unadjusted for inflation, so-called nominal spending rose to 0.6%, matching the median of estimates. So again, you're seeing just when inflation really starting to erode some of that spending power, which we're going to see here when you look at the rate of spending. So when we look at the spending that has happened, and I think it's important to highlight this, the level of in savings is down to the lowest it's been since 2017. So the savings rate, so U.S. household savings as a percent of disposable income declined to 6.9%. That's the slowest it's been again since December of 2017. Cumulative excess of savings, depending on which bucket we're talking about, the top 1%, which accounts for 70% of what is sitting in excess of savings, and then the other 80 per, really, so the 1% is 70% of that number. The next 9% is essentially 20% that's remaining of that number, and then the rest is spread throughout. So we've seen a lot of money get pushed into the system depending on where you sit in that backdrop. So even though the cumulative excess of savings looks really good, it's still very much weighted into one area, and a lot of this excess savings has come through, as we've been highlighting over the last several months, with the increase in payday loans as well as cash advances. So the savings rate coming down, I think, is more concerning because that is reflective of the aggregate, where the excess of savings is really honed in on the top 10%. So again, the savings rate is where we see the biggest concern on how much money is being put into savings to be pulled out at a later date. So then when we look at orders, November durable or goods orders came in again above expectations. We have this nice hook back. When you look at just a nice little bounce, we see this being fairly stable just based on where orders are. We've seen some of the leading indicators showing it's cooling slightly. Just because there's a lot of backlog. We see some new orders coming down, but depending on some of the leading indicators, they're a bit mixed, and I think this is showing you why, because they're good. They're still there. They're not a huge surge up. They're not a surge down. It's just really kind of steady as she goes, which is some of the underlying positive for some of the industrial side. Now looking and taking this to the U.S. personal income, this is just looking at it when it. I'm sorry, not the personal income side. When we're looking at housing, so now switching over to housing for a minute, in terms of where some of the different pieces are. So one of the things that we also wanted to say in terms of where some of these movements are going and how they're chained is really when we're starting to look at real estate, because when you start looking at the new one families sold, new home sales surge in November, up 12.4% versus 3.3% estimates. But versus the prior month, we saw a massive revision downward from 0.4% to negative 8.4%. So we just saw some of that delay from October into November. Medium home prices came in at 18.8% year over year, rounding it out at 416,900. So you're still seeing some of this movement. You're still seeing a lot of these price increases, which is also going to weigh in terms of where inflation is. Some of that push higher. Home prices are indeed an impediment to buyers right now, but the demand has not fallen all that much. Still up 14% year over year per the Redfin. So you can see where December is right now. You've come off the highs, but you're again still elevated, still higher. But as savings come down, as personal income erodes, that's when we see seeing a bigger pickup and slowdown. Rounding out, because we talked about Germany a lot yesterday, today, and well, we filmed it yesterday, but will be released today. Import price index month over month was expected at 1%, came in up 3%. Import price index year over year was expected at 22.3, came in at 24.7. Again, all of that leading to just more pressure and more movements to the upside in terms of inflation in Europe. And then when you look at Turkey, because we were having this conversation before we started filming yesterday, and I think this highlights, because the question is, what is Turkey doing? How can they defend the currency? And this is their war chest. So when they defend their currency, they're essentially trying to stabilize by holding firm at a very specific exchange rate. So that just means that as more lira comes into the market, they're buying lira and selling dollars or selling net foreign assets. And this just shows you how much pressure there has been on that currency war chest and the amount of assets that they have to sell to try to stabilize, which just means that they're running out of running room quickly. And even though they say they can defend the lira, this is just showing you how they really can, and they're running out of the ability to do so. So it's going to get interesting, as I've already said, but it really will. So it's hopefully we'll be here to give you some data, some guidance, let you know how things are coming down the pike. We for here at Primary Vision, a Primary Vision Network, which is obviously affiliated with Primary Vision, We wish you the happiest of holidays, a Merry Christmas and a Happy New Year. We hope you have time enjoying spending it with family and friends, and we'll see you in the new year. Again, I'm Mark Rossano from Primary Vision Network, wishing you a Merry Christmas. Thanks for watching.